And we're back. It's been a long time since we've done our last webinar, but after a long overdue little break for ourselves, we're back with Jason Meyer of Sprott, and he's a senior portfolio manager. And today we're going to talk about something called the flow-through limited partnership. There's not a lot of tax reduction strategies anymore. The government keeps taking away. This is one of the last ones. So what I'm going to do is I'm going to introduce Jason, and he can speak. Hello?
Hey,
Jason?
I'm here.
Oh yeah, Jason.
I'm here.
Feel free to introduce yourselves to our crowd.
Sure. Hi, everyone. My name is Jason Meyer. I'm a portfolio manager at Sprott Asset Management. Today's topic is obviously investing in flow-through limited partnerships. I've been with Sprott since late 2012. I have managed their flow-through limited partnership product line since 2012. So my track record encompasses those funds launched from 2013 onwards. We're currently in the market for the 2021 partnership, and in today's presentation, I'm going to walk through sort of how flow-throughs work and some of the strategies very briefly, and then we'll obviously open it up for questions.
Awesome. Jason, just wanted to kind of just mention one thing here, because this is an educational event. Let's not talk about any performance figures or anything like that. Or let's not talk about the specific funds. It's more or less just talking about how this flow-through product works. Is that fair?
Not a problem.
All right. So why don't we just jump right into our first question here? What are flow-through shares as compared to maybe like common shares or preferred shares?
Do you have the presentation that you can put on the screen?
Yeah, so he just put up the slide.
Okay, so if you go to slide 4, what are flow-through shares? So, I don't even like to categorize shares as flow-through shares because it does cause some confusion, because the bottom line is that flow-through shares are just regular, ordinary common shares issued by Canadian resource companies. So, when people want to know what the value is of their, quote, flow-through shares, end quote, they simply need to go to any quote service, and they can look up the value of that particular company, and that's the value of the shares. The difference is that when a company issues a share on a flow-through basis, they issue it from Treasury, and they agree to expend those proceeds on what are termed expiration activities. And these activities are defined in the Canadian Income Tax Act. And most importantly, from the purchaser standpoint, is that the entire purchase, those expenditures are 100% tax deductible. And the company, when they issue these shares on a flow-through basis, they agree to renounce or flow through those deductions to the purchasers of the shares that were issued on a flow-through basis. So those are what flow-through shares are. And if you jump to the next slide, we can talk about the limited partnership.
Yeah, so I guess just before we jump into that, the next part, so I guess each company has their own flow-through shares, and then I guess a limited partnership would be a pool of those shares. Is that correct?
That's correct. So in order to enable retail participation in the mechanism, so that investors can enjoy those tax benefits, many years ago the industry came up with this vehicle, which is the limited partnership. So effectively, the limited partnership raises proceeds, and then the limited partnership deploys those proceeds by purchasing shares that are issued on a flow-through basis, which is what we do at Sprott. So
right on.
as you see, so you see this schematic here. So what we do is we create a limited partnership. We go out and we raise money. Investors place money into the limited partnership. I then take those proceeds and go and purchase common shares issued on a flow-through basis, but from Canadian resource companies. Those companies, like I said earlier, agree to expend the proceeds on expiration activities. They then renounce or flow through those deductions to the limited partnership, and the limited partnership in turn renounces and flows through those deductions to the purchasers, to the investors. So at the end of the day, what the investor is getting is a diversified portfolio in Canadian resource stocks, and their investment is 100% deductible against all sources of income in that particular year. So if it was this year, for example, it would be against all sources of 2021 income.
Oh, wow. That's like it's almost like so the way you're saying it is it's almost like an RSP contribution. You get 100% deduction from your investment?
Correct. Yeah. So it's 100% deduction against, like I said, all sources of income. So some people always ask, it's against just employment income or dividend income. It's all sources of income. And in addition to the 100% deduction, there is also going to be, usually material tax credits that are also renounced. Those tax credits can range up to, depending on the jurisdiction, up to 20-25%.
Oh, wow. Okay. So I guess if I was to say someone was to put in some like 100 grand, then are they going to get 100 grand tax deduction or tax credit, and where is that reported? I guess that's on one of your slides.
Yeah, exactly. If you move to the next slide, we discuss it sort of details what your actual return looks like, because naturally when people see this and begin to understand it, they're taken aback by how generous the tax treatment is for these particular investments. So on this slide here, slide 6, this is an actual income tax return, a personal income tax return. You'll see that the entire purchase amount goes into box 224, so line 224. And you can see here that the effect of that line item is to reduce your taxable income. So a couple of things I want to communicate here is, number one, this is written into the Tax Act. This has been part of the Tax Act since the 1980s. We are not exposing a loophole. This is not transient. It's written to the Tax Act. There are defined rules about what qualifies for exploration and development expenses and so forth. At the end of the day, when the person's purchasing this, if we're considering an Ontario investor tax at the highest marginal rate, which would be 53.53%. So for, let's just say $100,000 investment, they will get back or reduce their income tax payable by, $53,000 plus.
Oh, wow. That's amazing.
The benefit of it. Yeah. And I'm ignoring here the tax credits.
Yep.
But that's just the deduction. And then on the next slide, I briefly touch on the tax credits.
Yeah. So before we go there, I want to if you guys are all looking at the screen right now, you can notice that line 208 is actually the RSP deduction. So 224 is where you would put in this this investment, right? And it acts the exact same. So if you have no RSP room, another way to deduct taxes is to buy one of these investments. Is that correct?
That's correct. It's one of the few bona fide shelters that are written to the Tax Act that are actually remaining to taxpayers.
Wow, that's amazing. Before we move on to the next slide, so I guess you mentioned 53% tax rate. So I guess who are these types of products suitable for? If I'm at the lowest tax bracket, I'm probably not going to buy one of these. Is that correct?
Yeah, look, this is, I'll disclaim it by always seek your own tax advice, but the general rules of thumb, the client needs to be taxed at the highest marginal rate, which I believe is it's north of 200 grand. I don't know the exact amount. I apologize, but it can easily be looked up. I would also recommend that clients, exhaust and maximize their RRSP contributions prior to considering an investment in this particular product. And then, in terms of a profile, this is most suitable for those that are consistently earning high income, where they're going to consistently be taxed at the highest marginal rate. And the reason I say this is ideally the strategy would be to commit to do this year in, year out. And the reason you want to do that is because the product can be very volatile. There'll be some years where it performs tremendously well, some years it performs okay, some years it performs poorly. And I know you don't want me talking about track record, but if you do take a look and share that with clients, you'll see that over time, the strategy definitely pays. The second category of client is someone who earns, call it a windfall earning. Maybe they were terminated, they got a large buyout from their company, or they have some large capital gain because of a property sale, whatnot. It's also suitable for that type of client. However, my only point of caution is then you're making you're making more of a call on the resource sector, because don't forget that's the underlying investment.
Correct. Yeah. So you have to kind of be liking the resource sector, because I guess these flow-through limited partnerships aren't all around for other types of industries. Is that correct?
That's correct. It's effectively strictly dedicated to mineral exploration, and that obviously entails base metals, gold, silver, platinum, palladium, and then obviously uranium, and so on and so forth. So if you're doing it on a one-time basis, we know over time that the peaks and troughs of the resource sector sort of flatten themselves out, and the track record of the product really demonstrates that. But if you're doing it on a one-time basis, where the resource sector is in terms of its cycle is a much more important consideration.
Cool. And obviously, if you're watching this webinar, contact myself and we can talk about where the resource market is, and we obviously can get Jason on the line if that's something that you want to do. So why don't we just jump ahead here and let's go into how this flow through limited partnership works, and I guess you got to go to the next slide for that.
Yeah, so this slide, and I don't want to get too involved here, but look, with this particular product, the most important thing that an investor can do for themselves is to really understand the tax implications and how this is looking on an after-tax basis. A lot of investors are consumed with sort of pre-tax returns. This being a tax product, you need to consume yourself with how it performs on an after-tax basis. So there's two key concepts that we want to communicate. One is your money at risk, and the second is what your break-even proceeds are. Now, I want to stress on this particular slide, this is actually from a prospectus. So this has been vetted by a third party. These are not numbers I am making up. This obviously, this complies with a very high level of disclosure. So as you can see here, we're using a very simple example, $1,000 investment. The total income tax savings in the year of investment is $685. And then beyond that, there's going to be some small taxes payable totaling $48. So if you go to the total column on the far right, you can see that you make an investment of $1,000. The total net income tax savings is $637. And sorry, by way of this is for an Ontario investor tax at the highest marginal rate.
Yep.
So their money at risk is $363 per thousand. So if the client buys this and it goes to zero, the most that they will lose is approximately 36% of their initial investment. So that's the money at risk. The money at risk the client has is approximately 36% of what they actually invested. Now the break-even proceeds, so this would be the value that you would have to recover so that the return was zero on an after-tax basis. So this break-even proceeds figure takes into account all taxes saved, as well as all taxes paid and or payable. So it takes into account all financial implications of this investment. Now the question I get is, why is the break-even proceeds greater than the money at risk? And the reason is that when you take this deduction, the cost based for tax purposes is zero. So, like I said, if this goes from $1,000, say, down to $10, and you sell it at $10, that $10 is going to be treated as a capital gain. So the break-even proceeds of the disposition is greater than the money at risk, because we have to account for the capital gains tax that is going to be payable when you actually sell the LP units or the mutual fund shares.
Oh wow! So you're essentially, what you're doing is you're buying this product and you've got downside protection built in, and then when you sell it, it's actually a capital gain. It's not even income. Yeah,
and the other thing too I'll point out is, obviously if you have capital losses to offset the gain, that would drive down the break-even proceeds of disposition.
Wow. That's amazing. So obviously, if you're on the line and this is and you've got some money, right, and you're in the highest tax rate, and maybe you had a house sale and you have a big capital gain, there may be some ways to actually reduce your tax bill. This is interesting.
Mm-hmm.
So why don't we move to the next slide there? And it's about the tax reduction.
Great. Yeah, sure. So, this is a very basic sort of example, and it is for illustrative purposes only. And the biggest assumption here is that when the client sells the LP, and you can see that in the LP dissolution year, that they are going to sell it for the same amount that they paid for it. And like I said earlier, this is a very volatile product. Sometimes it'll be worth more, sometimes it'll be worth about the same, and other times it will be worth less. It almost certainly won't be exactly what you paid for it, but nonetheless, you can see how robust the tax mechanism is and how that drives your return. So in this example, if you look in the investment year, you pay, we're using a $10,000 investment example. The tax savings in the year of investment is, this is for an Ontario investor tax at the highest marginal rate, so 53.53% of 10,000. You can see that in year one, your after-tax cash flow is negative 46.47. The LPs typically have a lifespan of 18 to 24 months. So when they terminate, presuming, once again, the big assumption here is that the client's able to redeem the LP for what they initially invested. They'll redeem it for 10,000, and then they'll have to pay the capital gains tax payable. As I just mentioned, the entire disposition proceeds are taxed as a capital gain. But because the capital gain inclusion rate is half of that for ordinary income, the tax hit is 26.77, which is half of the 53.53. And then you can see here in the column on the far right, the total column, you add up all the figures, you get after-tax cash flow of 26.76, and the after-tax return on the break-even proceeds is 54%. So, very, very handsome return, and that's driven by the tax deductions. Note that in addition to what you're seeing on this particular illustration, there will be investment tax credits, which would further enhance the return, but we try to keep it simple here.
I have a question for you. You said something about the term of how long these products last for. Is it 2 years max, or can it be as short as 6 months? Like, how does that work?
So per the prospectus, there'll be a particular date in the prospectus. So for example, if we're doing a fund now, the termination date would be at the end of February of 2023. However, we can terminate funds early. And in fact, if you look at our 2020 LP, which we launched last year, because the performance was so strong, we decided to terminate it a year early. So in this case, we're terminating it after 12 months. So from a liquidity standpoint, the lengthiest time would be, call it approximately 24 months, and that is detailed in the prospectus. So we are obligated to terminate it and provide investors liquidity prior to the date that's found in the prospectus. However, in certain circumstances, if the performance is good, we will terminate it much earlier than what is detailed in the prospectus.
And then for the investor themselves, does it actually make sense to, like, once you terminate this product, does it make sense to get rid of the product? Or I know there's some kind of rollover. Why don't you speak about that quickly?
Sure. So the way we provide investors to liquidity is when the LP terminates, the LP units are exchanged for shares in the 9-point resource class mutual fund. And this is done on a net asset value basis. So there's no fees, there's no friction costs. Everything's transparent because the net asset values of both the funds are based on current market prices, which are observable, obviously. So when that exchange happens, it's important to note that any outstanding capital gains tax is deferred as long as the client holds the mutual fund that they received in exchange for their LP units. And they will continue to defer their capital gains tax liability as long as they hold on to the resource mutual fund. However, whenever they choose, there is daily liquidity. There's no hold periods. They can cash out at any time they want. So really, it's a very, that would be based on the client situation and obviously in conjunction with your particular outlook on the resource sector at that time. But there are options, and there are tax efficient options if the client chooses to continue to hold the mutual fund that it rolls into.
So just to confirm that, if you have, once it rolls into the mutual fund, you can have all the liquidity that you want. But when you own the LP, flow through LP prior to owning the mutual fund, there's no liquidity. Is that correct?
That is correct. And that's very important that investors obviously understand and appreciate that once they commit and they purchase the LP, they will not have liquidity, and they could not have liquidity for up to 2 years.
Okay.
And that's not unique to our fund. That's the standard.
That's a standard, and there are lots of different companies that do provide these products. But of course, we're on the phone with 9 Point today, so we're talking about we're talking a little bit about theirs. So why don't we go to the next slide there? I believe it's about tax efficiency.
Mm-hmm.
So if you want to speak about this portion.
Sure. So I just put this, the tax reduction slide that we just previously reviewed, just sort of explains the mechanism, but there's many ways to use this product. And this is just one example of how this product can be efficient in optimizing a client's, tax situation. And obviously it's going to be unique to each particular client. But what we assume here, it's the same example as the previous slide. However, we're making the assumption that the client has capital losses that they can crystallize against the capital gain that is manufactured by this product. So it's the same example. You can see in the investment year, the client once again purchases $10,000 of the LP. They get their tax savings, 53.53, and then in the year that it terminates, presuming they redeem for what they initially invested, the $10,000, the capital gains tax in this particular example is 0. Because we're assuming that the client will offset their capital gains tax liability with their unused capital losses. And obviously you can see how that turbocharges the return and turbocharges the after-tax cash flows. And this is just one example, whether it's, it's crystallizing unused capital losses, there's some clawback, pension, old age security clawback strategies, so on and so forth. But this is just one example to illustrate that there's different ways to look at this product and how it can optimize a client's tax situation.
Wow, that's fantastic. I do have a question for you. When these flow-through products are purchased, there's obviously a purchase price of, say it's $10 a unit. The day that it starts, is the price going to stay at $10, or is it going to go down, or how does that work? Because the clients are going to see cost and market value, right?
Yeah, sure. I'm really glad you brought that up, because I think this is the most important thing that clients need to understand. So the units of the LP are issued at $25 per unit. There are going to be agent fees, there are going to be issue costs, and I pay premiums to acquire these flow-through shares. So presuming all of those things, I advise clients to expect that the net asset value is going to decline from $25, which is what they paid, to, theoretically, if I deployed all the proceeds on day one, that $25 is going to fall to $19. Obviously, the client, without appreciating the tax implications, is going to be a little upset about that. So you need to put that $19 into an after-tax context. So this is per the prospectus. Once again, I'm not making up these numbers.
Yeah.
The break-even point for an Ontario investor taxed at the highest marginal rate per the prospectus is, once again, I do not do these calculations myself. They're done by third parties, and they're blessed by the OSC. The after-tax cost, taking into account all taxes saved as well as all taxes paid and or payable, is approximately $12.50 per unit. And that's the benefit of buying this product. You pay $25, anticipate it's going to fall to between 19 and 20, and that's your tax arbitrage. Without the market moving, you're going from $12.50 to $19 just based on the tax implications. And when investors are holding it and they look at their statement, they need to look at that and have drilled into their head that their bogey, their break-even point, is $12.50 per unit. Anything above that they are making money on an after-tax basis, and obviously anything below that, they would be losing on an after-tax basis. But it's very important to understand how that NAV moves and what your after-tax cost is, which is $12.50 per unit.
Yeah, I think that's super important. A lot of people have purchased these types of products before, but don't really look at the after-tax basis. And it's good to know that you're buying it at 25 and your break even is 12.5. I think it's very, very important. That's correct, eh?
That is right.
All right. Well, I think we've been on the line for about 25 minutes right now. I don't believe our question and answers showed up today, so we don't have any right now. But this meeting is going to be put on YouTube, so you're going to be able to rewatch this thing again. If you have any questions at all about flow-through limited partnerships or how they could be of benefit to you or if they're suitable to you, I don't mind having a conversation with you, and obviously we can get Jason on the line as well. Remember, this is something that we can still use so that we can reduce our taxes. No one likes paying taxes, so it's good to see that we can still do something like that. Anything else to add there, Jason?
No, that's it. I think, look, I think this is a no-brainer strategy for those, like I said, especially for those that are consistently taxed at the highest marginal rate. Whether it's our track record or the industry track record, the product has worked. And, you know, putting my money where my mouth is, I purchase this product every year.
Every year. There you go. You heard it from the guy that makes these things. Well, thank you very much, Jason, for joining us today. I think everyone learned quite a bit about these flow-through LPs. If we have any questions, we'll be reaching out. And as always, we'll see you in a couple weeks for our next webinar. See you guys.
Thanks, everyone. Thank you for your time. Bye-bye.
Bye-bye.